Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on the stock market. So it's been a little while since we've looked at the SPX, looked at all of our 2008 fractals, told you what's happening next for the dollar, the VIX, the bonds, government yields, liquidity conditions. You know the gig. Let's dive into all of this and update this. Now, in terms of economic data, there's only this one article to update. Today we had a new update for the US Consumer Confidence Report, and it dropped down to 100.2, which represents a 1.96% decrease from the previous month at 102.2. Now, consensus was at 100, so technically it's slightly bullish that it was actually higher than consensus, but nonetheless, 2% drop is a 2% drop. It looks like consumer confidence is definitely decreasing. Stay tuned and we'll update you when the next consumer confidence report is, but from here on out, let's talk about the charts. Now, let's dive into this 2008 SPX Fractal. Now, like we said, I think the last time we covered the stock market in depth was probably like 2 or 3 weeks ago, and we basically said, hey, the S&P 500, if you're looking at the 2008 SPX Fractal, it's either topped out and it's going to roll sideways, or it's got a little bit more to push up to the upside and it's going to roll sideways, chop to the downside, and then absolutely plummet. Now, it looks like we've done the latter half. We've pushed up a tiny bit more, and now it looks like we're starting to roll down. In the past 2 days, we've dropped about $100 on the SPX, so a pretty significant drop. You can see on the weekly time frame, we're starting to put in a little bit of red. Over on the Heikin-Archies, we are still in this green trend, but it really does look like we are getting ready to top out and roll to the downside. As you know, if you're a veteran of the channel, we've been looking at this 2008 SPX Fractal. We use this to call this peak, we use this to call this trough, and right now, I'm calling for this to be the most recent peak in the market, and yes, I do think the S&P 500 is getting ready to break to the downside, just like it did in this fractal in 2008. Now, speaking of the S&P 500, not looking at what happened in 2008, let's look at the lower time frames, and I have noticed this Elliott Wave kind of playing out from the peak up here at 4,316. You can see boom, 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 boom. That is your bearish 5 wave to the downside. What have we done since then? A, B, C. And you can even count the individual waves of these just to verify this is right. 1, 2, 3, 4, 5, or sometimes these are a little bit ambiguous because you could draw this from this peak over here, but you've got a clear 5 wave, you've got an A, B, C, back down to the downside. Over on this 5 wave, you've got a 1, 2, this one is much less ambiguous, 3, 4, 5. Now, technically, in terms of peaks, on this 3 wave we went slightly higher, but you can draw Elliott waves to the candle body closes. So if you're drawing this from the candle body closes, a 5 wave may have already completed. If we do push up a little bit higher, we really do not have too much to go further to the upside before that next major breakdown to the downside. As you know, all of you Elliott wavers out there, after you have a 5 wave to the downside, you have an ABC correction to the upside. After you have this, we should be getting prepped for another brutal, 1, 2, 3, 4, 5, and this is probably going to take the stock market down into new lows. Now, let's talk about this reversion to the mean as well. Like we said, we've been sitting on the sidelines for the stock market for a little while now, but we've been waiting for that reversion to the mean. In terms of the EMA ribbons, we almost came up to the top of these and we've started to push back down to the downside. In terms of this mean trend line, you can see boom, you hit the trend line, boom, you hit the trend line, boom, you hit the trend line. We haven't quite made it up to the trend line. Does that mean that we have to come up to the trend line before breaking down? Absolutely not. We can be topping out right now. We could have already topped out. And when you are zooming in, you can see this beautiful bear flag is currently playing out. So what is my prediction for the stock market? I think one of 2 things happens. Either number 1, we break to the downside and we've already topped out, which is personally what I think is going to happen. If I'm wrong about this, yes, we can bounce at round about 3,930. If we start breaking beneath there, it is going to be curtains. And yes, it is a possibility we could once again reach this, 4,100 level before topping out. But, even if you're shorting now on the stock market, and, on my channel, I really like to focus on crypto, but we do look at the stock market because this is a leading indicator for Bitcoin. And what is this saying about the next move for the cryptocurrency markets? Well, if the stock market's topping out, if it's having a reversion to the mean, if we come over to the weekly time frame, if we're running into this resistance again, it should mean that, your Bitcoins, all of the cryptocurrencies should start rapidly breaking down to the downside. So I'll keep you up to date on this bear flag. If we do extrapolate the price target of this, you can see this will take us down to about 3,170, which from where we are now would represent about a 19.5% drop. Now, I really don't think this is out of the questions. You can technically see you know, right here, there's a sizable resistance that was flipped support at 3,250. So it could be a possibility that we do come down to these levels. And if you do zoom out, you can see the bubble territory of the, 2000 tech stock bubble and the bubble territory of the 2007 subprime financial crisis. Boom, like right down here, this is where most of the support is at 1,500. Now, I'm personally not saying that we have to go this low. It could definitely be a possibility, but at least in the immediate short term, this is the next target that I'm eyeing up for the stock market, 3,180. Now, it looks like we're breaking down, right? So let's get a difference of opinion. Let's head over to the oscillators. Let's look at the momentum in the market as we are coming back for this reversion to the mean. Now, as you can see, stock RSI weekly time frame, we are approaching 91. We are very overextended. What happened the last time we were this overextended? We pushed up for about a week or so, and then boom, we ran into the mean trend line, reversion to the mean, and we got pushed back down to the downside. Over on the money flow index, you can see, let me get rid of this for now. We've basically been residing at 50 for the longest time. This is absolutely insane. Considering we're in a brutal bear market right now, the money flow index being at 50 really shows us that, the volume overextension is the volume overextensions in this market is a little bit too much, especially considering financial conditions, liquidity conditions, which we will talk about towards the latter half of this video. So be prepared for that. But like I said, stock RSI starting to turn to the downside. MFI extremely overextended. Squeeze momentum indicator, we're still in red territory, but starting to push back up to the heartline, meaning if we start to break bearish, we're going to have so much room to move to the downside. It's not even funny. Even though I'm laughing, it is pretty funny, let's be honest. Now, let's zoom out. Daily time frame, as you can see. The only other thing I wanted to update on the daily... this has changed since the last time I've looked at it, so there are a few other things that I do want to update. You can see right here, boom, another reversion to the mean. On the money flow index, boom, 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 and we tried to come up to this and it looks like we're pushing back down to the downside. So it looks like in terms of the liquidity conditions, money that's flowed into the market, we are overextended. In the past 2 days, there's been quite a lot of volume coming into these markets. Because of this, stock RSI starting to turn to the downside. It has flipped bearish after topping out at 96. Typically when this happens, not a good sign. Over on the squeeze momentum indicator, you can see this is what I said hasn't updated, because when I was looking at this yesterday, and I believe I was looking at this morning, and I did not see this come out, so this may be recent. The squeeze momentum indicator is starting to tick into dark green, indicative that obviously, look at this, dark green pushed down into a new bearish trend. Now, once again, another very bearish signal. The last time we were in this extremely bullish phase and we started ticking into dark green and had enough momentum to push back down to the downside, we were all the way over here, 4,300, and we rocketed into new lows. You can also see massive overextension on the stock RSI as well, overextension on the money flow index, and this is what caused us to cascade into new lows. Now, this situation looks very, very similar. Once again, quick reminder, SPX Fractal is calling for us to be rocketing to the downside this week. If we come over to the Elliott Waves looks like we're starting a new 5-wave count to the downside. We've had a reversion to the mean in terms of the mean trend line, the mean moving averages, because remember, reversion to the mean just means mean price. You could look at EMA ribbons, 50-day EMA, you could look at a trend line, you could look at moving averages, whatever you want to look at to define the mean price, we've basically reverted back into it. So the S&P 500, it looks like we should be breaking down very, very soon. Let's head over to the VIX. Now, this 2008 VIX Fractal was basically in a do or die moment. Just like we've been talking about, it has predicted perfectly for us to come back down to this support and rocket back up to the upside. Now, this does look pretty brutal. We've got all these red candles. Do bear in mind the VIX is very one-directional. And what I mean by this is you can see as soon as an uptrend starts to come, you just rocket to the upside. As soon as a downtrend starts to come, you rocket to the downside. And you can see a lot of the time, rocket to the downside, rocket to the upside. This one was a little bit slower than normal, but this would be, much faster than any other stock market indices, indexes, etc. You can see we've rocketed to the downside, and in the past few days, the VIX has started to push back to the upside. Since the lows, we've literally pushed up about 10%, and this has basically been because of hawkish Fed commentary. The other day, we had Fed Bullard come out and say the first 250 basis points of Fed tightening were just getting back to neutral. So it's definitely looking pretty bearish for the VIX right now. We're kind of just chilling today, up about 0.6%. But like I said, the VIX is very one-directional, and when it does decide to snap to the upside, I mean, look at this. this. Could you imagine in March of 2020, people were probably like, oh, you know, the VIX is chilling, we're at this trend line, nothing to worry about. Boom! Boom, you just, like I said, very one directional. You just have these absolute runs to the upside very, very quickly. And this, in my opinion, is going to be what's happening very, very soon. The VIX is predicting a move up to 109. This would be about a 397% increase in the volatility index for the S&P 500. So it looks like we're already pricing in this bearish momentum in the next month because of the 30-day cycle forward volatility of the options expirations. Now, like I said, basically caused because of bearish or hawkish Fed commentary. I should say hawkish because Fed, hawkish, dovish, not bullish, bearish. Now, let's move on to the 10 years and the 2 years. Now, if you do want to know more about how this 10 to 2 year chart works, go check out my educational playlist. I've made a video talking about how to keep track of financial conditions. I won't explain how this chart works in this video. All you really need to know if you don't want to look at the fundamentals is technically the 10-2 goes to the downside and financial conditions tighten. Bonds get stronger. In the past day, we have moved up about 2.5%, but, you know, we broke down to new lows the other week, and it looks like we're coming back up to this trend line. Probably going to flip it as a resistance again before we break back down to the downside. You can see this nasty M pattern, and with the US 10-2 breaking to the downside, this is very bullish for bonds. Now, while the 10-2 is moving to the downside, we also need to look at the 10-year and the 2-year to see, you know, is the 2-year going down faster than the 10-year? And you'll understand why that's important if you do watch the educational video that I've made, Understanding Market Conditions. Like I said, I won't have enough time to explain the 10-2 in this video. If you want to learn about the fundamentals, go check it out. Other than that, I will just be talking about how this implicates the technicals. So 10-year is pushing up to the upside. This is bullish for government bonds. This is bullish for the dollar. This is bearish for the stock market. US 2 years as well. You know, they're still pushing up. They're at extremely elevated levels right now, but the US 10-year is just pushing up a little bit higher than the 2-year, which is why when we go over to the 10-2, we're getting a slight relief rally. Now, as long as the US 10-2 doesn't start rocketing to the upside, this is still a sign that financial conditions are working in the favor of the Fed, and they're still looking for more tightening. Like I said, want to learn more about the fundamentals, go check out my channel, my educational series. Now, moving on to the DXY, let's clear up this chart very temporarily. You can see that we do have an ugly but extremely valid potential diamond bottom formation playing out down here. Now, you see we've had a nasty breakdown into this. This doesn't look like a bear flag, bearish pennant to me. This, like I said, looks much more like a diamond bottom. And we have started to push to the upside of this today. As of the time of recording, we're only up about 0.05%, but nonetheless, we did have a breakdown and we started pushing back up and we've broken out of it. So while we're only up a tiny bit on the daily, do bear in mind that, you know, yesterday we were hugging this resistance line, we broke down, and now we're breaking to the upside of this. So I'll keep you up to date on the DXY, but it looks like the DXY is going to start pushing back up to the upside very, very soon. More about that in just one moment. And like I said, the path of most likeliness is probably for us to come up to the 1.236 Fibonacci, round about this 108.25. Now, if we come over to a slightly more macro picture on the DXY, you can see, you know, like I said, on the weekly time frame, you won't really be able to see this diamond bottom, but what you can see, as you can see right here, you had resistance at this box, you had resistance at this box, you had resistance at the wick at this box, you broke up and you flipped to support, you came up and made a higher high, and now we've come back down to this range, and from this low down at 104.6, we've made a higher high over here at 105.4. So DXY, higher time frames, lower time frames, everything still looks very good to me. All I see is resistance, flip support, resistance, flip support, resistance, flip support, resistance, flip support, again and again and again, with higher lows and higher highs all across the making. Now, let's head over to the TIP ETF. Now, in terms of the iShares TIP ETF, not too much to update since the last video. All I really want to say is that we are still in this bear flag. You can see that the other day we actually broke to the upside of this, broke back down and retested it. This is absolutely nothing to worry about. The tip is extremely knee-jerky. You can see price gap, knee-jerk to the downside, price gap, knee-jerk to the upside, and even though we broke out of this bear flag, we immediately had a failed move equals a fast move in the opposite direction and broke down to new lows. A lot of the time, if you're looking at the tip, if you try and draw technical analysis patterns on it, it tends to, you know, fake you out. It tends to break to the upside, break back down, and then have a failed move equals a fast move in the opposite direction. So in terms of the TIP ETF, it is looking very, very bearish for Treasury inflationary protected securities. Why do we care about what Treasury inflationary protected securities are doing? Well, if you're asking that, you might be new to the channel. Warm welcome. Let me actually check. How long ago was this? This was about 98 days ago. We were predicting for new lows in the stock market based on the fact that the Treasury inflationary protected securities broke to the downside before the S&P 500. Now, I'm not going to dive into the fundamentals for this. I've talked about this many times on the channel, but the TIP ETF are basically assets that are protected against inflation. And because of this, when these assets start to break down to the downside, the assets which are not protected by inflation soon follow back down to the downside. And like I said, you can see the TIP is a leading indicator for what happens next in the S&P 500. The S&P 500 is a leading indicator for what happens in cryptocurrencies. So, you know, while I'm a cryptocurrency channel and I talk about Bitcoin, Solana, altcoins, etc., you know, looking at what happens in these stock market charts that are underrated, and, you know, normal YouTubers don't look at these. Normal YouTubers just like looking at, oh look, this is the trend line we're in. If we break out, then this level. If we break down, then this level, blah, blah, blah. We're not interested in all of that. A lot of these charts, which are extremely underrated, literally do choreograph what happens next in the stock market. And looking at the TIP ETF, like I said, not too much to update, but it looks like we're getting pretty overextended right now. We're pretty weak, and we are still in a bearish pattern. Now, moving on from here, let's talk about the Dow Jones. Now, the Dow Jones, in terms of the 2008 SPX Fractal that we've copied, is really in a do or die moment. Now, the peaks and troughs are still pretty well aligned. You can see this peak was beautifully called, this trough was beautifully called. You can see this peak was somewhat beautifully called, this low perfect, top perfect, bottom perfect, and you know, it did predict for us to come up, round off, and break down to the downside. So if the Dow does come to this kind of level where we start tipping over and breaking down, I would still say there's an extremely high correlation, positive correlation between the Dow Jones in 2008, which is this bar chart over here that we've pasted over the current price action, into what is happening right now. Now, even if you're not interested in what happened in 2008, you can see the stock RSI is coming up to, you know, it's actually just broken out. It's kind of hard to see this. If I zoom in, you can see stock RSI has just broken bearish. And also, if we look here, the overextension that we had the other day was actually higher than this previous one all the way back over here. So, you know, what does this mean for the price action? Well, what happened the last time the Dow Jones was this overextended on the stock RSI? We basically broke down immediately into new lows, about 16% drop to the downside. So remember, the Dow Jones has a very, very similar chart in terms of the S&P 500. It is interesting to look at all of these together, but the Dow Jones starts breaking down, you know, the DXY starts breaking back up, the TIP starts breaking down, the SPX starts breaking down, and also with US consumer confidence breaking down, I mean, everything seems to, you know, tie into the fact that cryptocurrencies, the equity markets, they should all really be breaking down at some point very, very soon. Now, you can also see, if we look at some of our oscillators down here, the squeeze momentum indicator for the Dow Jones is extremely overextended right now. In fact, it has not been this overextended since the 3rd of May 2021, after this huge bull run to the upside, which should definitely tell you something about how overextended the Dow Jones currently is. Now, you can also see the Dow Jones in terms of peaks to peaks, peaks to peaks, peaks to peaks. We tend to follow this cycle of about 105 days peak to peak, 120 days peak to peak, 105 days peak to peak. So on average, it looks like we should be coming into that point where we should be breaking down to the downside very, very soon. Now, let's wrap up this video in terms of the liquidity conditions for the market. Let's start off on the E-mini futures for the S&P 500 in terms of the bids, the asks, the mid price, etc. Now, we're basically comparing this from the start of the year, so year to date, and you can see, if we're looking at the mid price, which is this blue line, you can see volume overextension, lower high, volume overextension, lower high, volume overextension, lower high, and quite recently, I can't actually zoom in on this, unfortunately, but the mid price for the E-mini futures for the S&P 500 have started to cascade to the downside after once again putting in another lower high and a lower low in October. So what does this mean for the price action? Well, when we're looking at what's happening right now, on the weekly time frame, it might be a little bit easier for you to visualize the book depth, but the volume is extremely overextended, which doesn't really make sense. And I'll explain why in a second. we're literally at these huge, massive volume overextension levels that we were at round about late August time. And if we come over to the S&P 500, what does this correlate to? Mid to late August, huge overextension in volume and a breakdown to the downside. Financial conditions cannot support the price of the S&P 500 right now. There's no way that the S&P 500 can hold the levels that we're at right now, and subsequently your S&P 500 should be breaking down and your cryptocurrencies should be breaking down as well. Now, in terms of liquidity conditions as well, we're still in very accommodative territory over on the NFCI INDX ratio. So, normally financial conditions snap up. We don't spend too long in restrictive policy. I mean, you can really see on this chart, most of the time we are residing within very accommodative monetary policy. And if you understand how the economy works, you understand why we're almost always in accommodative monetary policy. Lending is a huge part of how this economy even works. Without debt, the system wouldn't run whatsoever. So when we do push up to restrictive policy, it doesn't last long. It lasts maybe 4 months, well, 3 months, then the breakdown, 2 months, and then a breakdown. Over here, 1 month and then a breakdown, and we spent, the good part of a year, maybe more, over here in, just over a year back in the 2007-2008 financial crisis. And I've been highlighting a lot of similarities to what happened in the 2008 financial crisis. I mean, of course, you've just watched this video. We've been looking at the fractals from the 2008 VIX, the 2008 SPX, the 2008 Dow Jones. I mean, we look at a lot of these 2008 charts, and a lot of them, especially the SPX, have beautifully tracked so far. So I think very much so that something like this could happen where we have a knee-jerk reaction to the upside into restrictive monetary policy. And there's quite a few Fed officials right now which are also in agreement with myself, such as Fed Bullard, who said the first 250 basis points of tightening were just getting to neutral. So Powell as well is extremely hawkish on monetary policy, and we're still in accommodative monetary policy. And as well, if you come over to the IEF LQD ratio, it does display that financial conditions are, a lot tighter than they were at the start of the year, or even at the end of last year. But nonetheless, in the past few weeks, because we're seeing the stock market rally, we talked about this. If you do watch the channel, you'll know why the Fed doesn't want the stock market to rally. It counteracts their monetary policies. Now, if the Fed is trying to move to restrictive monetary policy and the stock market's rallying and people are taking out debt and companies are floating shares of equity to, fundraise, gain capital, etc. All of these things work completely opposingly of what the Fed needs to move into restrictive monetary policy. I talked about this in the last stock market video, but picture it the other way. Let's say we're in restrictive monetary policy. How will the Fed encourage accommodative monetary policy? How will it convince you to borrow money? How will it convince companies to float shares in the equity market? How will it convince me as an investor to start putting lots of my liquidity into the market? Well, I would want lower interest rates. I'd want to borrow money for very, very cheap. An average retail trader seeing their portfolio go up, they want more money, they borrow more, they borrow more, they borrow more. Companies see this, they see more money, they float more shares in the equity market, and you can see we've moved from restrictive to accommodative monetary policy. If you understand that, you understand the complete opposite when we're in accommodative monetary policy. The Fed does not want the stock market to rally. It wants government bonds to rally. It wants the profitability of government debt to rally. It wants the VIX to rally. It wants the DXY to rally. It wants the US dollar to outperform against, the other bags of fiat currencies. And once again, when the stock market rallies, like we're seeing here, financial conditions start to get looser as the S&P 500 breaks to the upside. So everything that's happening right now leading up to Jerome Powell's next speech, it's not looking very, very good, because the Fed, in my opinion, is going to come out with some very, very hawkish stances on monetary policy, just like we've seen from Fed's Bullards. So that's all I've got for you today, my friends. As always, if you do enjoy the content, make sure to hit that like button, make sure to comment, hit the notification bell, share the videos with your friends. As always, it's been your boy Cowboy Trades. I'm out. Peace.